Welcome back, folks. All right, just a quick little review and an introduction to a new PD array I'll make public. So we're looking at the dollar index as our daily chart, and we have basically just been meandering around the gap I told you about between these two weekly reference points. So without going into the weekly chart to save some time, that's what we're watching. I would have preferred to see it trade down into it a little bit, but it didn't do so. All right, here we are, folks. I'll take your attention back to the video I did on my YouTube channel, July 9th, 2023. It's a market review. And prior to this day, running off the weekly inversion fair value gap, I mentioned that we would open on a new week, trade down, use this inversion fair value gap from the weekly chart, and I'll count you to go back and look at the old videos. All of this is not added to the chart after the fact. We opened, traded down, rallied up, and then we had finally today market trade up, complete the weekly volume imbalance on euro dollar. So that is an absolute slam dunk. All net. Swish. Buy side. That was the initial draw. Then we would get into the weekly volume imbalance. Just a beautiful delivery. These are the types of moves that you want to capture and really sit on your hands and wait for. It makes trading very fun. But unfortunately, when these big, powerful moves take place, they don't give you a whole lot of opportunities. You have to know what you're looking for and then get in and try to avoid thinking that it has to retrace, because it'll just keep running higher and higher and higher. The reason why it's done this is because the dollar was exceedingly bearish, like we were expecting on July 9th. So E-mini S&P, here is our weekly chart. So I'm taking your attention into and beyond. This was the original weekly volume imbalance that we were talking about back down in here. We finally got into that closure today, this week rather. We traded to it and through it. Now we're looking at this volume imbalance. So there was two volume imbalances on the weekly chart for Nasdaq, and it had already completed both of them. ES has been lagging. So the ES has been the sixth sister between the two averages, and I mentioned that Nasdaq is the leadership issue. So you're all asking me, why am I trading Nasdaq? I'm actually in the Nasdaq as the leadership issue, so it's going to be an outperformer to the upside. But here we have a fair value gap in here with a breaker, and then we have bullish order block and a propulsion block, and the market sends price higher, completing this weekly volume imbalance in the pink, and then we have this one here. So you want to have these two levels here, the high and the low of the weekly volume imbalance. Have that in your chart and use them as potential support resistance. I see a lot of questions about this button down here for settlement. I like to use the settlement price toggled on when I'm looking for things like where we closed in reference to like the TGIF trade. Okay, I toggle back and forth between both of them. So I'm looking for volume imbalances. I'm looking for inefficiencies that may materialize. So things that might go under the radar of other traders. I'm looking at both perspectives. So it's not a matter of it only works for this, it only works for that. I'm flexible in terms of what I'm looking for in terms of imbalances and or where we actually close at settlement because of the TGIF ideas. All right, so we are looking at a daily chart here, E-mini S&P. You probably hear my puppy Bailey. I apologize if you do hear, but she's mourning like I am. We lost our other boxer, Bella, but she wants to be close to me, and I can't send her away while I'm doing this because I just don't have the heart to do it. So anyway, that's her whimpering. She's fine. She's just sad. So we have today's trading here, Monday's trading, and then here's where we were working off of this fair value gap right there. I mentioned, and I'll show you the tweet as it was today, but I've mentioned it many times over the years, that we do not try to pick tops in buy programs. Okay, and we don't try to pick bottoms in sell programs. That means we are always giving the market the opportunity to color outside the lines that most other traders would think that, okay, we're so overbought now, it has to come back now, it has to retrace, it has to have a retracement. No, it doesn't. It doesn't have to do that. And when the market is wanting to go higher, you have to submit to that, or don't trade, because if you arm wrestle it, you'll hurt yourself. So these are the levels we have on our chart now. So when we drop in lower time frames, it'll be much more meaningful to you. So here we are on the 18th of July 2023, and we had a small consolidation, and then we dropped down, took out sell side, and then a rapid acceleration into and above Monday's high, trading up into that higher weekly volume imbalance. All right, let's take a look at the 5-minute chart. Now I'm skipping over the 15-minute charts just for the sake of brevity, but these are 15-minute fair value gaps. So that way you can take a look at it on your 15-minute time frame. And an order block as well. We trade down and hit that. This is all 15-minute chart basis. I'm having it here so that way for your homework, you can go into a 15-minute time frame and find out what these are on the bellwether chart, which is 15-minute time frame. But the 5-minute, lots of opportunities, lots of entries today. Order block on the 15-minute time frame, order block on the 15-minute time frame. You can see the reactions off of it here, and then trading up into that weekly volume imbalance. Okay, moving on into Nasdaq. This is where the brass tacks are for this presentation. So I mentioned how we had these relative equal highs, and we were likely to go through that. Last week we did that, and now we are continuing through last week's high. And again, you're only going to catch this type of continuation if you avoid, make it part of your repertoire and routine as a mindset as a trader. You do not try to pick tops while the market's going up. You don't do it. You simply do not do it. It's far easier for you just to simply submit to the idea that it wants to go higher. So trade in that order flow. Don't look at patterns trying to capture market reversals, because they're going to run right over top of you. All right, here's the daily chart here, and we have an order block there. We talked about that propulsion block. We don't want to see a closing price below the middle or mean threshold of a propulsion block. We never saw that. The market rallied last week, and then now we had here Tuesday's trading. It's Tuesday still for me, and then Monday's trading here. So we had a really nice little drop down in, small little institutional order flow entry drill. Not by much, but you don't need much, right? So we'll take a look at that when we get in lower time frames, but continuation on the upside. Just a wonderful, wonderful opportunity to see that trade. Notice that we traded down today and cut through the candles because we're not supply and demand. That high. Went right down, revisited. That is a discount array. So if you look at my month 4 content of the ICT mentorship, it's my premium mentorship. Those core content lessons are on my YouTube channel. Go to playlist for month 4, and you'll see the PD array matrix lectures in that segment of videos. And in the discount, we have old highs and old lows. So when we trade back down in to it like that, when we're bullish, we would expect to see prices trade higher. All right, on an hourly chart, we can see that we have the market drop down. Small consolidation. This is where retail is going to see a bull flag. Okay, rallying, consolidation, and they want to see it go higher. I was asked today on my Twitter account, what my bias was. So I went over that and I'll actually show you the tweets. So that way it's not me just saying something and there's no record of it. But it had a really nice explosive price move higher. And cleared the 16,000 level. 5-minute chart here. You can see the low forming here just shortly after the 9:30 opening. Creates a fair value gap here, trades down into that. Beautiful run. Right from there, takes off. Small little fair value gap here. Hits it with an order block. Very, very high probability. Rallies. Order block. Rallies and then finds its high of the day in the last hour of trading. And then trading off the highs back into an order block. At 7:43 New York local time, I tweeted today and I said that we're not trying to pick tops in buy programs, okay? Basically, a buy program is when the market is under an algorithmic price delivery or price run that's repricing higher. It's not a classic bull market. It's not a trend, because I don't like talking about things in those terms, because I don't have any affinity for those types of things. I did when I first started, but once my eyes were open to how markets are highly manipulated, and then I codified a lot of the things you now are learning from me, I've completely dismissed everything else. So when I'm looking for higher prices, when my algorithm is looking for higher prices and it's spooling and running higher, I'm going to refrain from, and I teach my students to refrain from trying to pick tops. No matter what pattern you think exists in price action, no matter who you love and worship online, whatever they say, avoid it. I promise you, if you do that, you'll spare yourself a lot of losses. But yesterday was evidence that it's never a good idea or strategy. And I mentioned this morning, meaning July 18th, 2023, this morning, I am waiting to see if they use the retail sales data, which was released at 8:30 New York local time, to drop in, then rally higher. If it drops and doesn't rally, it matters not to me. Movement is desired. So what do I mean by that? Well, here is the 9:30 delivery. Okay, and this is the time of the tweet right there. So I was not counseling you as my students to look at that consolidation as a bull flag and go higher. I didn't want to see that. I wanted to see it go against retail mindset, which would be continuation or classic retail continuation patterns, and they would see and would have saw a bull flag. I'm not a fan of that. So the market drops down at 9:30, which creates a Judas swing. This market protraction in the opposite direction to what retail would expect. It goes down, creates a short-term little low, rallies up, and then dives one more time. That is absolutely beautiful, because that sets the trap for every trader out there that thinks that that bull flag was going to pan out, and then now they want to catch this low down here, then they get stopped out. That immediately scares 90% of any retail traders from wanting to go long. They don't want to go long now. They're scared. They're going to get stopped out, and they don't know what to expect. What I'm looking for is I want to see, does the market respect my PD arrays, my discount arrays, things that I would look to go long on in any bullish scenario. So now it's time for a new gift to the trading community. Okay, so I want you to take a look at how the market created a run higher last week. We had a run up and then a break lower. When we see that, you understand that this pattern here is if we trade above it, come back down in, that should be what? Treated as a bullish breaker, right? Not when we're in trend continuation. We're in trend continuation. I want to see the low, high, lower low, and then the next day, if we rally through it, like we do here, so here's Monday's trading. Now we have 1, 2, 3. Isn't that a 3 drives pattern? And that's a topping pattern, right? No. No. What did I say this morning? We're not trying to call tops. So anyone that would have saw this as a 3 drives pattern here, or 3 Indians pattern if you're a reader of Street Smarts books, which is, in my opinion, one of the better books out there. But that's not a three draws pattern. That's not a three Indians pattern. Okay, it is a setup for those individuals that want to use that idea. So one of the things that I codified in my algorithm is if there is a opportunity for the market to continue higher or lower, everything I'm going to show you here, just reverse it. But since I'm bullish, and I told everybody I was bullish, I was looking for a drop in. Drop into what? We'll get to that. That price level up there, 16,028.75. Absolutely random. No. If you look at the price range from the low to the high, this is a breaker. But there's something specific about this breaker that we have to know and then use it slightly different. Low, high, lower, low. This stops out longs. So longs are now no longer allowed to be participants of the next energetic price leg higher. I am not requiring price to trade in a normal sense with the breaker. I want to look for something different. This low up to this high, that is the standard measurement for projection on targets. So if this was a classic breaker, we would use the low to the high. And the lower low that goes below this low here, that sets the tone for the pattern as a breaker. But for swing projections, for targeting purposes, all we're doing is taking the low to the high, one standard deviation. That's what we're looking for. 16,028.75. I think it went one handle above it. Is that precise enough for you? We're going to go a little bit beyond that now. This is my ICT Reaper inversion fair value gap. Yes, I know it's a badass name, I know. A Reaper inversion fair value gap is when you're inside of a breaker, you're going to cut through candles because we are not supply and demand, folks. I can't stress this enough. This is one of those lessons where you can look at folks on the internet that try to say I rebranded stuff, or I call supply and demand something different, or I complicate it. Folks, there is nothing like this anywhere else. Okay, I wanted to create and codify a method to go in and capitalize on, number one, precision, two, take advantage of shifted sentiment, and go under the radar of everybody else out there. That's what my Reaper does. It's devastating. It's absolutely devastating because you don't see it coming, but it's right there. Price run leaves a fair value gap in the lower portion of this price run. Okay, so it's the first leg of the bullish breaker. The fair value gap must be in a discount relative to that low to that high. You see it here? Between here and here. That's a discount. The discount is being measured on this basis, the low to high. Once we have that, extend that forward. If we're bullish, in this case we were, and I've proven it to you. I told you we were looking for higher prices. The market trades down through it, doesn't respect that, as we would expect. Everybody that would see my stuff online or think they understand it or think this is a liquidity void, it's not. It's going to trade down through it, run the stops. Why? Because I want to knock those individuals out that have a trailed stop loss there. And then the market rallies on Sunday and the Monday. Takes out the high. Now, everyone that wants to use my breaker, they get punished here too. They're not going to be able to go in here and go long. And also, the traders that are using this as a bull flag, they're going to get punished. Now, I know if I was just to say all these things right here, this would have been like, oh, this is cherry picked. You're form fitting, you're doing this, you're doing that. I said it this morning before the market even got to 8 o'clock. It's 7:43 this morning, New York local time. I want to see it drop down into what? Monday's range. Here's midnight on Monday, New York local time, to Monday's high. Measure that. The best fills for getting long is going to be at equilibrium or higher. Except when my Reaper exists in price action. Cut through all these candles and go right there. We see it drop down. And then bang, that right there, that signature there, that's what I was looking for this morning. Because it was respecting all through here, and go right back there. Folks, this is proof that my algorithm refers back to candlesticks, highs and lows that you would never otherwise know. Where's the support and resistance idea? With all this, you're going to go right here, right? You're going to take that high and draw it out in time. Wonderful. But I've already told you, classic support and resistance is only confirmed if it has one of my fair value gaps. And look what it has right there. Consequent encroachment of that Reaper right there. But if you want to know, and you want to have all the details that I'm making available to the trading community at large, these are the things that I've codified. A Reaper is a fair value gap in a discount of the impulsive price leg of a bullish breaker. Reverse it. A bearish ICT Reaper inversion fair value gap would be a bearish breaker that would have a fair value gap in the premium side of the impulsive price leg. So all of these things are completely reversible, but the context is you have to have a bias. There has to be some kind of retail idea that would lure traders in. Well, we have here, bull flag. It drops down in to what? The previous day's range. Now, look at the bodies respecting 50% of the previous day's range. See that? Remember, the wicks do the damage. That's the Reaper's job. And then that little signature right there tells me it's done, it's going to go higher. I'm entering on that candle. Taking all that aside, if Reapers are a little above your pay grade and a little confusing for you, that's okay. I'll talk more about it in my book. We have our standard inversion fair value gap there within a breaker, classic bullish breaker. And then here's the price leg between the low of that candle and the high of that candle. Those are the specific price points. And my fill going long 6 contracts was 15,781 even below and inside the inversion fair value gap there at the candle that qualified and confirmed that my Reaper was in fact good to go, send price higher. And I took a market exit. It wasn't a stop out. I just simply closed it because my intentions were going to be somewhere else and I wasn't going to be able to do anything I wanted to do managing it on my cell phone. So there's where my close was, and went a little bit higher, went above the 16,000, but that's still good enough. Over 120 handles on Nasdaq, so about 14 grand plus. So not bad for a couple hours of leisurely fishing. And here is the 1 minute chart on Nasdaq. What I was entering also was we had this run up, and as the candle was dropping down, I'm going to enter that right there, and then this would be your classic return in for a fair value gap, bullish breaker, and then secondary entry would have been here. You could have took that one and ride on up, and this is where I closed it manually. So that, my friends, is what took place today, and it was a wonderful explosive price move today, higher after me counseling you this morning. We would look for a drop down in previous day's range, and just was beautifully offered. It was one of those days where when you know what you're looking for, and if you're struggling with trying to capture big runs, okay, if you're on these little time frames and you're simply just looking for things like, okay, well, here's relative equal highs, and say you did buy this, silver bullet. Okay, because that's what that was, by the way. This entry is a silver bullet with all the other things I gave in context. So, which is like a silver bullet on steroids. This here is a lunchtime macro. It starts running higher there. And you might think, okay, well, it gets above here, I'm done. But if you're ignoring the higher time frame that we're going to go higher anyway, we're going to keep going higher. We're not trying to pick tops and buy programs. And the daily range is likely to create that extreme high, if we're bullish, in the PM session, going into that last hour. Well, look what time of the day, the high of the day was formed, around 3 o'clock. It didn't go beyond 16,000 much. But I gave up about 100 handles. But that's okay. 120 is enough. Don't sit here and try to convince yourself that 5 handles is enough or 20 handles is enough. If you really want to capture big runs, you'll scare yourself entirely from holding on to them. And one of the best ways of doing it is when you get a entry, you place your stop. Don't worry about trailing it. Don't worry about trying to take partials. Just let it go. Turn off the charts. Go out like I did. I was away from the house. I wasn't looking at it because I'm not worrying about all of the things. I'm trusting my algorithm. I'm trusting what's codified. I'm trusting that the delivery of price is going to be exactly what it has been coded to do. Price the high in the afternoon session. The last hour, then you'll get your retracement. That's power 3. This is not the entire daily range here. I'm just showing you where my trade entry was and my exit. Remember, it goes higher than this. It goes to 16,000 something. And I didn't get all that. And I don't need to. So if you're looking for ways to hold on to a trade and capture these big runs, not just get 10 handles or 20 handles and, yeah, this is great. I'm killing it. You may very well be killing it, but you're missing these monster hauls by not knowing the higher time frame bias, not understanding what the likelihood of a large range would do for your trading and your equity. And you don't need to have a full position on. Like, this is my initial entry. Usually it's 6 contracts. I was tempted to go in and do 4 more here. I said, I'm just going to leave it there. I'm going to leave it there, and I'm not going to worry with it. And while I was out doing what I wanted to do today, the market just kept on plowing higher, smashing everybody that was wanting to go short. On the heels of, they're going to use the retail sales number and then going into 9:30, drop it down, create relatively cool lows, rally it sharply, fair value gap, sells off. Now retail doesn't want to be long. So as long as they're afraid to buy it, that's a welcoming feeling for me with a smart money mindset with trading. I want to go in when they're fearful. What time do we trade for a silver bullet? 10 o'clock to 11. Displacement, down close candle. As it's trading down, I'm buying it. This right here could have been another 4 contracts. And then I'd have my full 10 positions, which is my standard model for trading index futures. And then rallied up. I'm not in front of the charts. My stop loss is below this candle's low right there. That's where the stop was. And you've seen me use tighter stop losses than that. But it went down into the fair value gap there. If I would have saw that, I would have did another entry just to prove to you I was trusting the pattern. But I wasn't there. I wasn't watching the chart at the time. And just kept on moseying up. And because I wasn't in front of the charts, and because you wouldn't be in front of the charts when you're training yourself to do this, you put a position on and you just let it go. If it stops you out, it stops you out. It's not going to be the last trade you ever take. But you have to condition yourself like this to hold on to it for a long period of time by not looking at the chart. Because it's real easy to see this, think, okay, I made a lot of money now. Let me just get out of it. No. Trust the time of day. Trust it. And the market just explodes higher. Hopefully you found this one insightful. and it was beneficial to you. Obviously, it's just an introduction to my ICT Reaper inversion fair value gap. I'll have more talk about that in the book. I won't be releasing anymore because I already know somebody's going to come out here, maybe many of you are going to come out there and try to create little tutorials on YouTube and misinform everyone because you don't know what you're doing. Please don't try to do that. Okay, I understand you want clicks and all that stuff, but you don't know what you're doing, and you don't know what I'm going to teach about that very specific PDA rate. So I want to introduce it today, and I hope you found it inspiring and interesting. Until I talk to you next time, be safe.